The Buffett indicator is at an all-time high. So what does that mean? It means Warren Buffett's been selling stock all year and has built up a cash pile of $325 billion in Berkshire Hathaway, essentially dry powder for some time in the future when he's ready to buy stock again. Okay, but first a little explanation as to what the Buffett indicator actually is. The Buffett indicator is the ratio between the total U.S. stock market capitalization against the gross domestic product of the United States. The Wilshire 5000 stock index is what's used for the total stock market capitalization, and then we get the GDP from the U.S. government. So just some history on why this is called the Buffett indicator. In 1999, Warren Buffett wrote an article for Fortune magazine explaining this as a way to measure the value of stocks compared to the size of the economy. And the reason he did this is because in 1999, we were in the dot-com bubble, and it was an era where stocks were highly overvalued compared to GDP. And he was using this as a broad measure to show how the valuations of stocks were quite out of line with what the historical trend had been compared to GDP in the past. So just by having these two factors, the stock market capitalization and the GDP, and if we follow them over time as a ratio, what happens is we get an average of that ratio over time, or a mean over time. So historically, we can see times when it has been overvalued or undervalued. Then, of course, there is a fundamental tie between the stock market valuations and the GDP of the country. When you think that companies, broadly, have a big impact on what the total gross domestic product is with their earnings. And at the same time, the valuation of companies, the stock market price, is in some way fundamentally based on the earnings of those companies. So over time, there should be this correlation that keeps these two factors within a reasonable distance of one another. So when we look at the Buffett indicator over time, and we have that mean, we have the long-term historical trend, the mean of that ratio, we can kind of see what's overvalued and undervalued, or times when the stock market has been overvalued compared to the GDP or undervalued compared to the GDP. And obviously, if it's overvalued, it's probably not going to stay too highly overvalued for too long. So when we look at the chart of the Buffett indicator, what do we see? Well, down below 100%, you'll see the gray dotted line that is the mean. That's the long-term historical trend. Now, if you look back to dates like 1980, you'll see we were well below the mean. And what that signifies is that the valuations of stock, the stock market capitalization, was lower than the historical average of that ratio of stock market capitalization to GDP. And that was also true in 1990. If you go to 2000, that's where you see the stock market bubble, and it's well above the mean in 2000. Then again in 2007, it was above the mean. 2007 was mostly a housing crisis, so the stock market was less involved in 2007. But then after that, it did drop down below the mean again. And since the Great Recession, you can see over time, the stock market has climbed continuously up until the pandemic really had a big spike there. But again, we're now at all-time highs as far as the ratio between stock market capitalization and GDP. And this brings us to Warren Buffett's behavior with buying and selling stocks. He sees that the U.S. stock market, in historical terms, compared to the mean, is highly overvalued compared to that mean ratio. And he uses that as an indicator to tell him that the stock market is overvalued compared to the size of the economy. So this is why Warren Buffett is selling stock and sitting on cash, because he thinks eventually these stock prices are going to go down relative to GDP. That probably means repricing in stocks, lower prices in stocks. So that was a brief explanation of the Buffett indicator. If you have any questions, just let me know.